Hello and welcome to another brand new episode of What the FinTech, the podcast from the team behind FinTech Futures and the Banking Technology magazine. My name is Paul Hindle, editor at FinTech Futures, and for this episode we're joined by René Michau, Global Head of Digital Assets at Standard Chartered. René, welcome to the show.
Thank you so much for having me. It's great to be here.
Excellent. It's great to have you here. And just to get started, would you like to quickly let us know a bit more about yourself and your role at Standard Chartered?
Of course. I'm René Michau. I'm the Global Head of Digital Assets at Standard Chartered. So that means I have the pleasure of sitting within the investment bank, but working across the enterprise with our wealth and retail business, with our SC Ventures division. And I get to spend a lot of time with regulators and policymakers, and then also with our clients across all of the different sectors that we serve.
Excellent. Sounds great. And again, great to have you here. And thanks so much for taking the time out to speak with us today. So on the show this week, we'll be exploring the growing impact of stablecoins in financial services and their potential to reshape key areas of banking and payments. We'll discuss the current state of play with stablecoin adoption in banking, their rising popularity among corporates and institutions, and the benefits they can offer, particularly in terms of cross-border payments. Beyond payments as well, we also look at use cases gaining traction and how Standard Chartered is integrating stablecoins into its digital asset strategy. And we'll also explore the current regulatory landscape around stablecoins, the key elements banks should focus on when developing an effective stablecoin strategy, and of course, what's next for stablecoin innovation, including how they're likely to evolve in the coming years, their impact on traditional banking models, and the innovations and partnerships that will shape their trajectory going forward. So to start off with then, René, can you give us an overview of the current state of play with stablecoins, and how is the industry's attitude towards stablecoins evolving, and what role do you see them playing in the broader financial ecosystem today?
That's a great question. As we think about stablecoins today, it's helpful to think about where they originated, right? So around 2014, we were looking for, as an industry, the crypto industry is looking for a representation of US dollars that lived on blockchains and would settle in the same time window as a Bitcoin transaction or an Ethereum transaction. And that was when we saw the evolution of Tether and several other attempts at stablecoins as well. And I guess for the first part of their lives, they've largely stayed focused on that settlement instrument for crypto transactions, and they performed very well in that context. We saw the evolution of USDC and several other stable coins as well. And I think it's fair to say that up until a few years ago, we really saw that settlement of crypto transactions, both in DeFi and in centralized finance, so on exchange and in just decentralized finance apps, as the killer use case for stablecoins. There's lots of experimentation around different models for stablecoins, including other algorithmic, those that are backed by fiat, etc. But I guess when we talk about stablecoins today, and particularly we talk about those in the context of the current economy, and particularly in use with payments and the way that payments companies and other fintechs are interacting with them, we're typically talking about the fiat-backed stablecoins. And what's really interesting about that is I guess we're seeing the breakout of that crypto settlement use case. We estimate that somewhere in the vicinity of 40% of the total market cap of stablecoins is actually a savings use case. And that's, in emerging markets for both those that are gig economy workers perhaps, and at that smaller end of savings, and maybe they live in a high inflation market, so that emerging market use case, or maybe very wealthy people that are looking to insulate themselves against certain risks. That's a fast movement away from this sort of centralized exchange and DeFi use of settlement. But perhaps more interesting than that is, particularly through our Zodia Markets subsidiary at Standard Chartered, but also in other parts of the business, we're seeing particularly US dollar stablecoins being used for complicated cross-border transactions. Many of those are in markets where correspondent banking has retreated over the past decade or so, where perhaps the correspondent networks are underserved, and therefore access to payments is really well suited to stablecoins. But even more interesting than that, we're seeing lots of use cases where corporates are saying, okay, we need to make a time-bound payment over a weekend, for example. One use case here is ships in ports. A ship is unloaded in a port on a Friday night, but traditional payment rails can't get the port payment through until sometime on the Monday. And it can be up to $60,000 a day to keep a vessel in port. So that's just one example of where we're seeing a lot of corporate treasurers start to explore that use of stable coins. But let's not forget retail. We do see, in terms of consumer use of stable coins, that more and more e-commerce marketplaces and indeed physical locations are starting to accept stablecoins as a form of payment. So I don't think we're in danger of stablecoins becoming the dominant mechanism for payment in the next couple of years. But I think we need to be considering that stablecoins are going to form a part of the payments mix for individuals and for corporate treasurers over the next, now and into the next decade.
Excellent. And I mean, stablecoins have been around for a while now. What's really driven that surge in popularity over the last year or so, would you say?
So I think that can be attributed to a few things. I think obviously the rise of cryptocurrencies as an investment opportunity has meant that more people are familiar with custodians of crypto wallets or crypto wallet operators potentially operating wallets on exchanges or even their own personal wallets. And therefore the step to a stable coin is much smaller. But perhaps more importantly, we've also seen a greater awareness, a greater number of institutions providing access to digital assets and providing access to stable coins, which means that kind of that nexus of ease of access and the complicated problem to solve has come together to make this a viable payment option for folks. And let's not forget many of the stablecoin issuers working very hard to drive adoption of their stablecoin and are doing a lot of work with different corporations, different individuals, marketing the benefits of stablecoins.
Excellent. And how is Standard Chartered currently engaging with stablecoins then, and what role do they play in the bank's digital asset strategy?
Yeah, so for Standard Chartered, when we talk about digital assets, obviously we mean cryptocurrencies, we mean stablecoins, we mean tokenized deposits, central bank digital currencies, tokenized assets, and kind of any of that realm of digital assets. We're very focused on being where our customers want to be. If we have a look at Zodia Markets as a subsidiary of the bank, it's a majority-owned subsidiary, originally registered with the FCA in the UK, but also operating across Europe and the Middle East. They're principally a brokerage company, and they broke cryptocurrencies, but also stablecoins. What we found is that by offering stablecoin services across not only the two major US dollar stablecoins, but also across multiple different currency stablecoins, we've been able to see quite a lot of interest across particularly institutional clients, and Zodia is focused on institutional. So that's one sort of aspect that we're focused on. We've established a subsidiary in Hong Kong where we've applied for the license, and we're also looking at ways in which we can provide greater access to stablecoin payments for our clients as well. We very much see them as a part of our overall proposition. As part of our security services business, we also offer custody for a whole range of digital assets and through our Zodia Custody subsidiary as well. And so a lot of the time we're able to help clients move from fiat currency into stablecoins, but also keep those stablecoins safe, both within the core bank, but also through our Zodia Custody subsidiary.
Excellent. And do you see the growing adoption of stablecoins maybe as a stepping stone towards broader institutional usage of cryptocurrencies or other digital assets as well?
It's interesting that you say that. I think people look at the investment in crypto assets, Bitcoin and Ethereum in particular, as a very specific use case. And there's slightly different drivers for each of those things, but ultimately that's much more on the investment side. Stablecoins increasingly are being seen as a form of payment, which offers a great deal of transparency, 24/7 availability, and some certainty around the delivery of the payment. But I do see them as a mix of new forms of money. So including other forms of tokenized money, potentially the use of tokenized deposits through a clearing infrastructure like Partior or Project Agora by the BIS in order to allow banks to interconnect their deposits. So I think that certainly on the institutional side, corporate treasurers are looking across multiple versions of this. I think in the retail context, a lot of that is likely to be driven by what payment companies, merchant acquirers, and e-commerce platforms do with respect to stablecoins. And I think as we have those conversations with our clients operating in that space, I think that there is increasingly a demand from SMEs and consumers to have stablecoins as a payment option when they get to checkout.
Excellent. I guess building on that, I mean, what are some of the key benefits then that you would say for banks and corporates as well when it comes to stablecoins?
The bank question is interesting, and let me start there. I don't think that looking at the way that stablecoins function today would logically say that there's a logical step for banks purely on the nature of stablecoins. But what I would say is that throughout the history of banking, we've bearer-style instruments as a banking industry to expand market opportunities. They tend to be very portable. If you look at the advent of paper instruments, they increase the portability of money and some of the certainty over long distances to allow trade to occur. And I think stablecoins perform as a style of bearer instrument, really provide some very similar capabilities to the initial bearer instruments that we saw. I mean, bearer instruments have been around for a very long time. They're really codified in the Bills of Exchange Act of 1882 in the UK and subsequent acts across the world to put some legal structure around them. And in some ways, you can draw a parallel with stablecoins that, a highly functional, high utility bearer instrument is a very efficient way of solving certain problems, allowing human collaboration and commerce over very large distances leveraging the internet, which is kind of, what we're talking about, internet money. And so for a bank to not be engaging in that topic feels like a choice to not participate with where our customers are already deciding to go. So I think in that respect, it's really important that banks are engaging and making sure that they have the capacity to manage the associated risks and participate with that effectively. As we think about corporates, we've watched the global economy move online. We've watched that whole move around e-commerce. And I think given the nature of this publication, that we're talking about today, FinTech companies really have evolved around that, solving that payments problem for internet-based commerce. And payments companies, wallet companies, and e-money firms have really done a great job of leveraging the existing foundational banking infrastructure to connect that to the internet. But at the end of the day, money still doesn't really settle in the same way that the internet works, right? If you look, most RTGS systems are based off designs from the early 90s, which predated the mass adoption of the internet. Swift itself was launched in the late 70s and therefore, again, built on technologies which predated the internet. And so the way that we're set up in the way that the banks work isn't really the same technology stack, the same time horizon as internet commerce. So I think that bridge between large-scale blockchains and stablecoins and money that moves over internet infrastructure is just that internet adoption of money in a way that matches the way that commerce is already working. We don't go to Encyclopedia Britannica anymore to look up facts. We have Wikipedia in our pocket and many other sources of information. And this is really that transition. And I think that's how corporates are starting to look at this. Actually, we now have a form of money that seems to be working in the same way that we're invoicing, that we're looking at our supply chains, that we're delivering goods over this highly efficient infrastructure.
Excellent. And you mentioned there, obviously, banks need to be engaging with this now. One thing I did want to touch on, Standard Chartered recently highlighted that US banks could lose up to $500 billion in deposits to stablecoins by 2028. What are the key factors driving that shift, and how should banks adapt to remain competitive in this changing landscape then?
Yeah, I mean, I think that there are lots of factors driving a shift in the way that bank liabilities work. We are moving to a T1 or T+1, right, a next day settlement window for capital markets. We're likely to move to a T0 settlement window for payments through the real-time payment systems, and therefore potentially capital markets as well. And that's irrespective of stablecoins. I think it's helpful, and we certainly at Standard Chartered are looking at the risks of how the liability book might change over time with new technology and with these different initiatives as well. And I think all banks should be paying attention to that. We are seeing an increase in velocity for commerce, for bank balance sheets, and responding to that in a sensible and well-managed way is critical. And really that, I guess, trend is happening in some ways irrespective of what individual banks do, right? This is market forces driving the fact that we want to have more real-time settlement, higher velocity monetary system. And so therefore whilst stablecoins are a consideration and the migration of that is a consideration, the overall view of treasury risk and how a bank balance sheet is going to operate is absolutely critical for every bank treasurer to be looking at.
And what key elements or considerations should banks focus on then when developing an effective stablecoin strategy? And are there any lessons that Standard Chartered has learned that could guide other institutions in the space?
Well, I mean, at the risk of, I wouldn't want to push strategy into any other bank's mouth. But I think some of the considerations that are helpful is familiarity with the underlying technology. I do think that banks are in different positions in the way that they engage with blockchains, and in particular, large-scale public blockchains. So financial crime risk, we need to incorporate on-chain analytics to be able to look at public chain data in order to manage that risk effectively. Market risk, when we launched Bitcoin and Ethereum on our FX desk in London, being able to look at the market data as it relates to crypto trading was an important part of our market risk and capital calculation. So deciding on that risk infrastructure is a key part. And understanding the risks associated with the asset class. So that includes crypto, stablecoins. I mean, the fundamental risks are very similar, but also the technologies that support that, whether that's key management, whether that's managing wallets, whether that's directly integrating or indirectly integrating with public blockchains. These are the areas that I think are helpful for firms to consider. And I think there's sort of three questions which I think are helpful. One is, as a firm, what do you think is going to happen with digital assets? Was a question we asked ourselves. Question two, who are you as a firm and what's the role that you play or want to play in the ecosystem? And then in light of the answer to those two questions, what do you need to be good at is the third and perhaps most important question at the end, right? So I think they're helpful to kind of go, okay, well, if we think these three things are going to be true and we're this kind of bank and we're doing this for our customers, then we need to be good at these things over here.
Great. What would you say the big challenges then associated with stablecoin adoption for banks, and how can, I guess, firms mitigate those risks?
Yeah, that's a great question. When we get to the risks of stablecoin adoption, I mean, with every risk comes an opportunity. The role of banks is to appropriately manage risk in order to help their clients achieve their financial objectives. So I think some of the things to think about. Where is the stablecoin market cap and which stablecoins are being used, and why are customers looking to use that as a form of payment? Again, what do we need to be good at? I think a lot of the risks, again, what I've touched on relate to that underlying technology. Can you understand the risks associated with permission blockchains, large-scale public blockchains, the way where various activities are occurring, but also the ecosystem? Who are your partners and who are you interacting with? Who are you working with? I do think that taking a traditional banking organization and asking a broad range of folks to become familiar with what is a new set of technologies and new sets of assets is a pretty complicated journey to undertake. And so having bankers who are curious and are leaning into new knowledge and willing to engage broadly in the ecosystem and in the asset class is crucial. And that's true whether you're talking about your product teams, your client-facing teams, your leadership team, your second-line teams, or even your auditors. I had the privilege of having my audit team on many occasions at digital asset and crypto conferences with me. So it's nice to have that level of engagement from all three lines of defense in the bank, where they're leaning into learning and understanding so that they know how to do their existing job better. And I think that's kind of the key message.
Excellent. And I guess on that front, I mean, regulation is always a key talking point with any emerging technology, especially with digital assets as well. What's your view on the current regulatory landscape for stablecoins and what challenges or opportunities does that present?
It's really fascinating to me just how engaged regulators across all markets are in digital assets overall. And that includes with stablecoins and cryptocurrencies and all sorts of digital assets. But what I can say is I have the privilege to spend quite a lot of time with regulators and central banks and policymakers. What I would say is no one is trying to not engage with this. Like, there's so many really intelligent people trying to game out all of the long-term implications of these new asset classes and new forms of money. And whilst we are seeing differences in approach across various different markets, the way that the MiCA regulation, the way that the Genius Act proposal, the consultations from the UK regulators, from HKMA, from MAS, all of these regulators that we interact with, they're not identical, but the problems they're trying to solve are the same. And I think what's really heartening and rewarding is just the depth of engagement that we have, both internally within the regulators, but also even if you just wanted to track the number of consultations that have come out from regulators to industry on stablecoins in particular, it's a very large number. And I think that really represents a kind of almost sitting on the same side of the table trying to solve a problem collectively, rather than a one side of the table, either the regulated firms or the regulators trying to run off in their own direction. So I think broadly speaking, I think it's absolutely fascinating to be working through that with so many smart people. And I do think we're going to end up with some commonality across the stablecoin regulation, but certainly some nuance as well, because stablecoins really do mean different things for different markets.
Excellent. I guess on the topic of different markets then, you touched on it earlier, US dollar peg stablecoins currently dominating the global market. What are your thoughts on that trend? Do you see growing demand for non-USD stablecoins in certain regions or use cases?
So I think that there's lots of reasons why, a sovereign or a central bank or even any kind of regulator might be interested in having their own currency stablecoin. We have talked about, I think through our research team, the risk that there may be some level of currency substitution or adoption by certain parts of certain economies of US dollar stablecoins because of the access to US dollars. Not everybody can get access to a US dollar bank account to hold that as a currency should they want to. And the practical paths for individuals to get access to US dollar stablecoins are, to be frank, easier. And so I think that then becomes a consideration for individual countries and regulators around whether or not it makes sense to have a domestic currency stablecoin. We've recently entered a sandbox in Malaysia to explore a Malaysian ringgit stablecoin in partnership with AirAsia or the Malaysian regulator. And that's just an example of where people are asking the question, what does it look like to have a non-US dollar stablecoin? For our Zodia Markets business, we have seen across different currencies a reasonable amount of volume in non-dollar stablecoins and FX between dollar stablecoins and non-dollar. So I would say that there's definitely interest in multiple different currency stablecoins, even though the vast majority of that remains denominated in US dollars. And let's not forget, the US dollar stablecoins have been around for a lot longer than many of the other currency stablecoins. So I think we're optimistic that, well, not at least we think that there is likely to continue to be multiple currency stablecoins, and we're certainly seeing interest from clients in those.
Just building on that, then going forward, how do you see stablecoins evolving then in the next few years? What impact will this have on traditional banking models, would you say?
Well, like I said, I think there's quite a lot of folks that are interested in this. I think a helpful assumption would be the following. It's worthwhile to assume that a good proportion of corporates and individuals will be using stablecoins for about 5% of their payments that cause them the biggest problems. Now, it's a pretty general statement. I think watching the e-commerce space is actually going to be a really helpful bellwether around the integration of Stripe and many of the other payments companies and PayPal of stablecoins into their infrastructure, and the adoption of that very much in that e-commerce context. If we see that increase, particularly with smaller merchants operating on e-commerce platforms, I think that will be a helpful bellwether around, stablecoin adoption. I don't think they're going to go away anytime soon. I think we're going to see complementary products around tokenized money market funds and other forms of tokenized assets that are complementary to stablecoins. But I think as we look forward, the places to look are large corporates starting to use stablecoins. Are we seeing those for settlement for e-commerce transactions? And that would be a helpful indicator. But, please do feel free to keep reading Standard Chartered research, because I'm sure there'll be more coming out from that team on the trends and data that we're seeing in the market.
Excellent. Yeah, and I guess on that front, to finish off then, how does Standard Chartered plan to expand its stablecoin related offerings in the coming years?
Well, I think for us, we do intend to try and make it as easy as possible within our regulated entities for clients to be able to make and receive payments in stablecoins. Today, what we have is we have Zodia Markets and we have the custody propositions, as I mentioned. To some extent, we're still exploring what does it look like to have a bank that's issuing stablecoins, and do we need to issue all the time, or are there other services around that we can provide? So very much we are in that kind of, you think this is going to be important, and we're working to make sure that our clients can have access to that to the extent that they need them. And we hope that will be very helpful to our clients.
Thanks again, René, for chatting with us today. To close out the podcast, we have our now infamous FinTech Jail. This is where we ask for an industry term, buzzword, or trend that you've seen or heard enough of. Or, of course, you can advocate a free one of the previously incarcerated terms. So what would your selection be for this week?
I'm fascinated by the fact that everyone has a platform these days. I think in order to have a platform, you really need to have some scale, have developers building on top of your platform, and have a two-sided interactions with the platform. So I think the overuse of the word platform sends that to FinTech Jail for me.
Nice. Is there anything you would want to replace platform with, or is it just that it's just being used way too much at the moment?
No, I think it's just being used inappropriately.
Yeah. Fair enough. Well, that's a good enough reason for me. And we're more than happy to add platform into the gel this week. And we'll see you later down the line if anyone wants to advocate to break that back out again. But for now, René, thank you so much again for joining us for the podcast today. It's been a pleasure.
Thank you so much for having me. I've really enjoyed it.
Well, that's all we have time for this week. Thanks, of course, to René for joining me. As for FinTech Futures, you can find us online at fintechfutures.com. Be sure to follow us on LinkedIn to keep up with the latest FinTech news. If you like this podcast and our other episodes, you can subscribe on Apple Podcasts, Spotify, SoundCloud, or your favorite podcasting service to get notified about future episodes. Thanks as well to Arama for editing this podcast. You can check them out at arama.tv. As always, thank you very much for your support, and we'll see you soon for another episode of What the FinTech. But until then, goodbye.